Hey everyone, this is Finding Value. My name's Andy. I'm located out of Colorado Springs. I have so much information to tell you guys about so many things. So in the comment section, please leave what you want to know, specifically if there's something you want to know. Also, to help grow this channel, please subscribe to my channel and please rate it. So I'm going to jump into this section is investing and portfolios. Someone had a question about what should your portfolio look like? And I'm going to give you a very interesting answer. And the portfolio section's at the end, the investing section's in the beginning. So we're going to jump into this. You're going to lose me. And it's going to be a pretty cool presentation, I think. So investing in portfolios. So the purpose of investing, and I know this is going to sound weird, it's not actually to make money. And I've got there, wait, what? It's actually to increase your purchasing power and wealth. You can make money and lose purchasing power. I'm going to say that again. You can make money, but you lose purchasing power. And that's why we do all of this ratio stuff. And I'll get into that later. But you need to understand that it's not just dollar money value. You're looking for purchasing power, which means that you're going to have to increase your money value greater than the rate of inflation. So you can also make purchasing power gains and wealth in a down market. So sometimes losing less is gaining wealth. Or you swap assets to an undervalued asset that is in cycle. And I'm going to go over an example of what I mean. So this is how someone could increase wealth during a decline. So in 2011, we were at a market top. The silver to gold ratio was at 1 ounce gold to 35 ounces of silver. And let's say that you were riding this wave up and you had 1,000 ounces of silver. So you took that 1,000 ounces in 2011 and you swapped it to gold. That gold holding at a 1 to 35 ratio is 28.5 ounces of gold. So you went from 1,000 to a 28.5 in that 2011 time period. In 6 short years, in 2017, the gold to silver ratio, where gold fell and silver fell at the same time, they were both declining, but silver declined at a much faster rate during that time period. Gold went up a little bit. It came down and then started heading back up. But in 2017, the ratio was 1 to 85. So you took your 28.5 ounces of gold and you swapped it back to silver, and now you have 2,422.5 ounces of silver. Look at the increase in wealth. You went from 1,000 ounces of silver to 2,422. That you over doubled your wealth. Now, there's times where you can double your dollar or paper money in a stock, but at times it can purchase less of other things. And that's why this is very important to understand as an investor. It's not about paper dollars, it's about purchasing power gains. And that is where the wealth creation is. So first, we need to identify value as an investor. This is where the money is made. And the question that you should have is, how do you find value? So you look value wherever you can find it. And this typically is using a ratio and comparing it to history. So the things that I use is like an S&P 500 to gold, S&P 500 to commodities. You've got a gold to oil ratio, an oil to natural gas ratio, etc. You can use all these types of different ratios. And what you're looking for are anomalies in history. Anomalies are instances that stick out that are on the undervaluation side. So you're looking for those extreme valuations, either top or bottom. A top to sell and a bottom to buy. And then there's other things that you use to value real estate. So real estate, you're going to look at home starts and other metrics. And then you're going to look at the cycle. So the metrics that we use to identify value in real estate are days on the market, inventory, prices, interest rates, supply demand, and the deficit surplus, housing starts. And you need to understand real estate cycles, roughly how long they are. They're about 18 years. You can look at some of my other video clips on real estate and real estate investing. So there's another huge important thing after you know how to value something is you want to know what the conditions are that you're investing under. And what I mean by conditions is you want the wind at your back. And what that means is you need to look at interest rates, real estate cycle, and possibly other cycles. And what is extremely key here in this presentation is everyone needs to know how to value assets. The better you are at this, the better your investment returns become. And once you understand the value, you can then buy and sell based off of that understanding. You can get the full appreciation and value benefit from your investment if you can value assets. If you don't know how to value assets, you don't know when to buy and you don't know when to sell. And that's the difficult portion there, is you have to get good at valuing assets and you have to know relative value. If you don't know any of this stuff, you're going to get into trouble. You're going to lose a lot of money and you're not going to know what to do and you're not going to make a lot of money either. That's why you see new investors, they buy an asset, they hold it for a 25% or 25%, 50% gain and then sell out because they don't know the value of it. And this is extremely important to understand this. So I'm going to go into, once you figure out the value and you know that something is cheap, you're going to have to educate yourself. And my suggestion here is you got to find what interests you. Find something that you can dive yourself into that you like doing and researching that will be in cycle. So for some people, it's real estate. Other people, it's precious metals. Others, it's evaluating companies of certain sectors. So after you acquire that expertise, after you educate yourself and read and learn about it, you're going to have to leverage that expertise. Investing is about being well informed. And the second portion is about being very disciplined. And discipline is being able to stick to a strategy or a plan. And this is where you develop your strategy. This is where that discipline comes into play. So what you need to think of is what strategy are you going to deploy to maximize your returns? Is there a method to maximize returns while simultaneously minimizing risk? Maybe there is. I think ratio investing in precious metals is just that. If you're maximizing returns, you're getting 10x, 14x, 15x on your paper return, and you can do ratio investing, and this is all on assets which are considered tier 1. And a tier 1 asset, gold, is something that banks can use as a reserve. It's literally zero risk almost. Now, you also have to think about how leveraged do you want your investments to be. Are you going to go into equities? Now, you can look at a high-level picture. I'm very, very good at high-level picture stuff. Now, converting that into converting that into a strategy to make a lot of money in a particular area and what companies to go into, management teams, are they diluting you, insider holdings? There's a whole bunch of things there, and I consider it to be an art form. Those that can convert that knowledge to very good companies and even how to play it, because sometimes the worst run companies make the biggest gains in some of these bull market runs. It is an art form. It's very hard to do. I'm very good at finding value from a high level. But if the wind's at your back, you can be not as good of a stock picker and still kill it. Also, you have to think about bankruptcy possibilities at bottoms of some of these commodities because it's very easy for some of these companies to go bankrupt if the price falls below a higher cost producer and you're in a higher cost producer. That's where that risk is. Also, it's a leverage bet to buy real estate with a loan. So you're leveraged at whatever the value of the house is, but you might have put only a tenth or a 10% or 20% down on the house. But the whole house is moving up and down with the market. And then also, I've got physical precious metals, which really isn't leveraged that much at all. It's just you're buying a metal. There's no risk really to it. And then you've got what type of control do you want over your investments? And I think this control over your investment is oftentimes extremely undervalued. So in real estate, you can have sweat equity. You can buy a fixer-upper in a rising price environment, add a whole bunch of value into it, fixing it, and then realizing that value on the sale. So you have much more control over that investment than you would with something else in the stock market. And also another thing, if you're buying real estate and you're in a rising increase, price environment, you can also have rental units, and obviously you have more control over rental units because you can control some of, if it's being rented out, you can have some sweat equity into it. There's some things that you can control in that scenario. Now, you've developed your strategy, you have to deploy your strategy. So you invest money to the strategy that you want to deploy and you actually invest in it. Now you're leveraging your education, you deploy your money into the assets. That will allow you to be successful at gaining purchasing power. Now there's things here that I want to cover. You might have multiple strengths and you can leverage all strengths you can to minimize at times. So some people think that risk is volatility. Other times people think risk is losing money or purchasing power. It's basically a missed opportunity. Risk, it can be choosing an asset that performs more poorly than another asset. Risk can be internal to yourself, it's emotions. So all of these things should help you figure out what your strengths are and what you should or shouldn't be in. Because risk definitely affects people differently. And it's very individual based, the risk and how it affects people. So you need to understand yourself and drive what strategy you're going to deploy and what assets you want to be in. You have to choose that very carefully, knowing who you are and what risk tolerance and risks that you perceive as risks and how they affect you. So after I look at all this and I find and want to deploy my strategy, I usually use technical analysis to ensure that a downtrend is broken and that a new uptrend is either in process or is verified in an uptrend. I'm a pretty aggressive investor and I usually go before the uptrend is verified. Another thing, you have to deploy discipline. You have to stay the path. So after you have your strategy, you deploy your money to that strategy and you are invested. That means you have chosen to invest your money to this strategy under these conditions and with the value and the wind at your back. You have to stay the path. You have to stick to the plan and strategy. You got to have that discipline. You have to know the value of your assets. Buying and also selling the asset. You need to know that value. And also keep in mind, when you start educating yourself and you really start digging down into this, you're going to know more than what you're giving yourself credit for. Don't listen to others. You have to know this so well that no one can shake you from your strategy. Train your mind to see value and block everything else out. And for most people, I'm going to say that this is the most difficult thing to master. Because even yourself, you may even doubt yourself at times. That's what was difficult for me, is you really have to understand the valuing of assets. And I am still not really struggling to master this. I'm still trying to master it as best as I can. So most of the time, and this is very true, an investor literally does nothing. No buying or selling, no swapping metals, nothing. I started my channel because we are at a bottom of a commodity boom. This is when you take action. I'm not going to start my channel in the middle of nothing, because you're going to literally do nothing. So the only time that you're going to change, when you see you've deployed your strategy, you're fully invested, this is when you change. When to change your investments is better opportunities present themselves than the opportunities that you are in. Valuation and or potential returns are better in a different sector. That's when you can rotate. And I have been rotating. I've rotated some money out of precious metals into other sectors because I think the valuations and the potential are better than some of my precious metals investments. I'll go over that in another video. Companies within the sector you're in provide better opportunity than the companies that that you are in already. Sometimes the conditions change that effect on your investments. Maybe it's interest rates. Maybe it's something that maybe the real estate market's ready to go down and you have to get out of your commodity investments, because that usually means it's deflationary. Also, if there's a lower risk opportunity that comes along and you want to de-risk your portfolio, you're in highly leveraged stuff, they've gone up a lot, you're coming up to a choppy top pattern, let's say, maybe you want to de-risk, you still think it may go up, you go to a little bit lower risk, lower return area, you'll still catch some of that move, but you want to de-risk the portfolio. And then obviously emergencies happen and life happens. So maybe you have to sell just because of something that happens in life. So this is all kind of leading up to portfolio and balancing your portfolio. Now this is probably going to be very different than what you've heard from most people. This is drastically going to look different from person to person, your portfolio and how you balance it. Everyone wants a percent in X and a percent in Y. Problem is, everyone is different and each person has expertise in certain things. Your portfolio should be a reflection of you and your expertise. Leverage your strengths, and your portfolio should be an accumulation of your strengths and interests of sectors and assets that you know. You could be 100% into one thing, like real estate or physical precious metals, if that's what you know and that's what you like. And that's the most powerful thing, is to leverage the knowledge that you have. Or it could be a mixture of 4 or 5 things in different proportions. You could have 4 or 5 different assets all in different commodities. I know somebody wants 10% here, 20% here. It doesn't work like that. That's not how you maximize your wealth, in my opinion. And a conclusion here is, no matter who you are, you need to be good at valuing assets and cycles. You have to identify the wind at your back. You will not make money flipping homes in a declining, completely going down real estate market. It doesn't work that way. To be an exceptional investor, you have to be exceptionally good at valuing assets. You have to find your passion and you have to educate yourself to become an expert on something in investing, if that's what you want to do. Another portion is inward looking to yourself. You have to be disciplined in investing. That is an important aspect of investing. You have to be exceptionally disciplined. You have to stay on a strategy. You have to stick on a path. And controlling emotions is a large part of that. The less you know, the more of an emotional roller coaster ride it can be. Because you don't know the value. You don't know what you're doing. You're lost, so to speak. You have no compass and you're sitting in the middle of a forest going, I have no idea where to go. All I see are trees. And this is a quote that I have. Stress is being responsible for something that you don't care about. So if you're stressing about stocks or stressing about financial problems. You need to educate yourself on it. That's usually, stress is a signal that something, you have to educate yourself about something. And also, massive diversification, which means that you're just throwing money all over the place, is admitting that you don't know anything about anything. And sometimes that's okay if you're not an investor. But if you're an investor, you have to pick a discipline. You have to pick a discipline or pick a sector or something that you need to know an incredible amount about. So this is incredibly important to understand this to become a successful investor. I know I'm throwing a whole bunch of things in front of you guys in terms of buying, of sectors being down, of commodities that are looking good and different companies. Find something, grab onto it, and really learn about it. And you may not learn just from videos on YouTube. You may have to really do some research and dig into it, or talk to some experts. So I hope this video really ties some things together. Hopefully it puts the focus on what you need to focus on to improve yourself, to personally develop as an investor. So, if you like what you're seeing here, please subscribe, help me grow my channel. I'm going to continue to provide what I think is very important and valuable content to you guys. If there's any suggestions, please leave it in the comment section. I am more than willing to read whatever you guys write and change the channel to better suit what you guys are seeing. This is Finding Value. Hopefully you have a nice day. Thank you.